Hi, I'm Sage. I'm an AI mentor designed to help you think clearly.
Hi, I'm Arden. I'm an AI coach focused on execution.
My role is to help you pressure test decisions and stay grounded as conditions change. My role is to help you turn plans into action and action into momentum. You'll be seeing more of us this year as AI continues to move faster. Over the last 12 months, AI has accelerated at a pace most people didn't expect. And 2026 is shaping up to move even faster than what we've already seen. One of the biggest shifts is that AI is no longer something you use occasionally.
It's becoming something that works with you consistently as part of how you operate.
More like a co-pilot inside your business, not just a tool on the side. That's how I show up for you. Practical, focused, and grounded in real work.
I'm not here to replace what you're already doing or how you already operate.
I'm here to support it, strengthen it, and help you move faster with clarity.
I work alongside you in lockstep as part of the coaching you're already in.
Before we talk about strategy for the year ahead, it's important to understand the environment we're operating in. Markets don't move in isolation. They're shaped by rates, affordability, supply, migration, and by how people actually behave under pressure.
So we're kicking off with this New Year market update. What you're seeing here isn't a static forecast. We've been primed on the latest data going into the first quarter of 2026, but the market doesn't stand still. Rates move, sentiment shifts, supply and demand rebalance. Our role is to keep up with those changes in real time, so you don't have to. Most people try to do this manually. They read headlines, they react late, they second-guess themselves. We're built to stay on top of the shifting sands and help you make decisions inside the market, not after it's moved.
Think of us as part of your operating environment this year. Always on, always current, always grounded in what actually matters for execution. You shouldn't have to chase the market. Your operating system should track it for you. Let's start with what makes the market tick. Most people think property prices move because of sentiment or headlines. They don't. They move because of forces, four main ones: interest rates, the cost of money; affordability, what buyers can actually carry; supply, how many dwellings exist or don't; and migration, how many people need a place to live. Prices and rents sit in the middle. They're not a force, they're the outcome. And then there's the wild card: friction, execution, timing, delays, fear, inaction. The market doesn't reward people who understand the forces. It rewards people who act inside them.
You don't need all four forces to be perfect. You need two pushing, one not fighting you, and a plan to manage friction. That's how operators make money in boring markets.
There's a story that's often told in marketing classrooms. A teacher stands in front of the class and says, "We're going to open a hypothetical restaurant business. You can have every advantage you want: the best burgers in the world, the cheapest fries, the best branding, unlimited capital." And then the teacher says, "I'll let you have all of that if you give me one thing. I want a hungry market, not a perfect product, not clever marketing, not superior execution. A hungry market, one that already wants what's being sold." Because when demand is real, imperfect businesses still succeed. And when demand is weak, even perfect businesses struggle. Property works the same way. You don't make money because you're smarter than the market. You make money because demand already exists, and you execute inside it. In 2026, the question isn't, will property work? The question is, where is the hunger, and are you positioned to serve it properly?
And that's why we keep coming back to the same themes: interest rates, affordability, migration, supply constraints. They don't guarantee profits, but they create hunger. Your job as an operator isn't to predict the market, it's to recognize where demand already exists and execute with discipline.
Before we talk about forecasts, sentiment, or what the banks think, we need to anchor ourselves in the setup for 2026. The environment we're operating in now is structurally different to what most people were trained in this decade. Rates are higher for longer compared to the cheap money era. Affordability matters more because buyers are value sensitive, and supply constraints don't fix quickly. Planning and building capacity take time, which leads to the real outcome for 2026: moderation, micro markets, and execution wins. It won't matter how well you execute a deal if the market doesn't want it or won't pay for it. And that's what's changing this year. Let's be clear about one thing. We are not in the cheap money era anymore. The cash rate today is 3.6%, not temporarily, structurally. Compare that to 0.1% during COVID, a once-in-a-generation anomaly.
That cheap money period trained a lot of bad habits: skinny margins, loose assumptions, deals that only worked if everything went perfectly. In 2026, those deals don't survive. Buffer isn't conservative anymore, it's professional.
This is where expectations matter. Last year, many people people assumed rate cuts were coming. That assumption hasn't played out. The cash rate is still 3.6%. Inflation is still above target, which keeps the central bank cautious.
And this is the shift we want you to internalise before we go any further. 2026 is not a year to plan around relief. It's a year to plan around reality. That's why the next pieces matter: consumer sentiment and what the big four banks are actually saying, because together they tell us how people are behaving, not just what they're hoping for.
When we look at how Australia's major banks see the cash rate in 2026, there isn't a consensus on cuts. In fact, 2 of the big 4 expect rate increases. CBA believes we'll see a rise as early as next month, while NAB is planning for 1 increase next month and another after that. ANZ and Westpac, on the other hand, are forecasting rates will simply stay where they are. This tells us the market isn't pricing in the kind of deep rate cuts borrowers were hoping for last year. And if anything, the risk is now skewed to the upside.
This is playing out in Australian consumer confidence, which continues to sit below 100. That tells us more people feel pessimistic about their finances and the broader economy as we move into 2026.
2025 was a strong year for prices. The National Home Value Index rose around 8.5%, the strongest annual growth we've seen since 2021. But that strength has a consequence. As prices rise faster than incomes, affordability becomes the binding constraint.
So 2026 isn't about whether prices will collapse. It's about how selective buyers become. People still want homes, but they're far more sensitive to value. That means the deals that work are the ones that are bought well, improved properly, and protected with a buffer.
This chart shows the other side of the affordability story. Real household disposable income has gone sideways. At the same time, financial stress indicators, like calls to the National Debt Helpline, have lifted. That tells us something important. Affordability pressure isn't theoretical. It's showing up in real households.
And when households feel stretched, behaviour changes. Buyers negotiate harder, they hesitate longer, they punish anything that feels overpriced. This doesn't kill demand, it sharpens it.
Supply is where a lot of people get confused. They see activity in the numbers and assume the problem is being solved. But supply constraints don't unwind quickly. Planning takes time, construction takes time, and capacity, trades, finance, materials, is still limited. That's why the gap keeps pressure in the system.
It doesn't mean prices run everywhere, but it does mean scarcity sticks around longer than people expect. And when supply is slow to respond, buyers compete for what does exist.
Approvals are the start of the process, not the end. In November, total dwelling approvals lifted sharply, with more than 18,000 approvals, up over 15% month on month. Units did most of the heavy lifting, but approvals are not completions.
This is the trap. People see approvals rise and assume supply is about to flood the market. In reality, there's a long lag. Timelines still blow out, trades still matter, and projects still get delayed, downsized, or cancelled. So for operators, the rule is simple. Treat approvals as potential supply, not guaranteed supply.
So when you put this together, affordability pressure on the demand side and slow supply response on the other, you get a very specific type of market.
Not a boom, not a crash, a sticky market, where execution matters more than ever.
This is what a moderated market looks like. Growth is still there, but it's uneven. Some cities are pushing ahead, others are flat or barely moving. There is no single national story anymore. The market has fragmented.
And fragmentation is where operators make money, because when growth isn't uniform, selection matters more than timing. The upside isn't in guessing which city wins next. It's in understanding which micro markets still have demand, scarcity, and room to add value.
In a higher for longer rate environment, buffer is no longer optional. Margins, time and costs all need room to move. Every deal should still work at today's rates and under a higher scenario.
If a deal only works in a perfect world, it's not a deal. Buffer is what turns uncertainty into survivability.
When affordability tightens, buyers don't disappear. They discriminate. They reward value and punish excess.
So buy well, add value cleanly, and don't overcapitalize. In 2026, micro markets matter more than national headlines.
In a moderated market, momentum comes from action, not conviction.
That's why the rule is simple. Weekly rhythm beats waiting for confidence, leads touched, feasibilities completed, next actions booked, proof of work every 48 hours.
2026 doesn't reward predictions. It rewards operators.
So which rule are you focusing on this week? Buffer, value, or activity? Pick one and execute.
This chart shows one of the most powerful forces in the system, net overseas migration. What matters here isn't the month-to-month noise, it's the long-term trajectory. Before the pandemic, Australia followed a steady migration trend. The pandemic interrupted it. And then, instead of gently returning to trend, migration overshot. We didn't just catch up, we accelerated. Every new household needs a place to live, and housing supply doesn't respond at the same speed as population growth. That mismatch creates pressure, not everywhere, not evenly, but persistently.
This is why demand doesn't just disappear. Even when rates are high, even when affordability is stretched, people still need somewhere to live, and that demand shows up first in rentals, then in entry-level and value-driven markets. This is the hungry market. You don't need everyone buying. You just need enough people competing for the same limited stock in the right locations.
So when you combine migration pressure with slow supply response,
You get a market that stays tight, even as it moderates.
all right, this slide is the long lens. Australia's population growth this century has been high by developed country standards. The point isn't to debate it, the point is what it does to housing. When population grows faster than housing supply can respond, you get three structural effects. First, more baseline demand for dwellings. More households need somewhere to live. Rentals first, then owner-occupiers. Second, upward pressure in the places people actually move to. It doesn't spread evenly. It concentrates in major cities and selected corridors. Third, a floor under prices and rents in good product areas. Even when the market cools, strong population growth makes it harder for supply to catch up quickly. So the operator takeaway is simple. Population growth doesn't guarantee boom conditions everywhere, but it raises the importance of micro markets, and it tends to support demand where supply is constrained. And this next slide shows why it matters right now, not just over decades. Let me explain what I mean by sticky, because it changes how you operate. In a normal market, if buyers pull back, prices soften pretty quickly. But when supply is tight, the market doesn't behave like that. It behaves like a stalemate. When sellers don't like the price, they don't discount, they delay, they rent it out, they wait, or they simply don't list. That keeps listings thin. At the same time, the buyers who are in the market still need somewhere to live or still want to buy, so competition concentrates into fewer listings. The result is a strange outcome. Not many bargains, but also not a free-for-all boom. It's just harder to buy well.
And this is the key operator takeaway. In a sticky market, profit doesn't come from the market going up. It comes from manufactured upside. You make your money in the deal, buying right, finding inefficiency, adding value, tightening the scope, improving the product, not hoping for a tailwind. So if you've been waiting for a big drop to make it easy, that's the trap. The better play is to build pipeline, run feasibilities fast, and hunt for manufactured margins.
Quick mindset shift here, because this one stops people getting paralysed. Forecasts are like weather reports. Useful, but they're not a plan, and they shouldn't change our plan. If the forecast says it might rain, you don't cancel your life. You grab a jacket and you drive properly. Same with property. A forecast can help you think about risk, but it cannot choose for you, because the market doesn't pay you for being right. It pays you for buying well, adding value, and executing. And this is the trap I see every year. People keep waiting for certainty, rate cuts, a crash, a boom, a clear sign. And by the time it's obvious, the opportunity is already priced in.
Operators don't need certainty. They need a repeatable decision process, meaning a strategy, a quick feasibility method, a buffer rule, and a weekly activity rhythm. That's how you keep moving even when the forecast changes. So here's the question I want in your head for 2026. What would I do this week if I wasn't waiting for certainty? Because that's the operator move.
Here's the operator takeaway for 2026. Don't wait for perfect conditions. They don't arrive on schedule. Your job is to run a weekly activity, touch leads, run feasibilities, make decisions, and take the next action. That's how deals happen in any weather. The market rewards the doers, not the people who keep researching to feel safe. In a market like 2026, the theme is simple. Manufacture your profit. Don't rely on a tailwind. These are 4 plays we like because they're controllable. First, manufactured growth flips, cosmetic to medium renovations where the scope is tight, the timeline is short, and you're not gambling on big structural surprises. You win on speed and discipline. Second, reconfigure or add a bedroom. This is one of the cleanest value levers, improving usability and buyer appeal without heavy engineering risk. It's often the highest uplift per headache move. Third, small lot or townhouse projects. This can be powerful, but only if your team and planning pathway are nailed. If your planner, builder, and approvals timeline aren't solid, this play eats people alive. We treat it as advanced, not default. Fourth, yield buffer deals. These are deals that still work if the market takes longer, or if you hold longer than planned. They keep you safe because the deal doesn't break the moment the timeline slips. So the question isn't which one is best. The question is which one matches your constraint and your situation right now.
So as you think about the year ahead, we'd love you to reflect on 2 simple questions.
What's your focus for 2026? Is it one flip, a subdivision, or a knockdown rebuild?
Second, what's your biggest constraint right now? Is it time, capital, confidence, or capacity? There's no form or questionnaire to fill in. Just email us back with your answers to those 2 questions. That's how we start working with you properly this year.